Investing is one of the most powerful tools for building long-term wealth, yet it's also one of the most misunderstood. Many people believe investing is risky, complicated, or only for rich people and professionals. Others think investing is about getting rich quickly or finding the next big opportunity. In reality, successful investing is not about speed or luck. It's about patience, discipline, education, and time. In this video, we're going to cover investing basics step by step. We'll start with an introduction to stocks, bonds, and ETFs. Then we'll talk about how to start investing even if you have very little money. After that, we'll explain risk versus reward and how to manage risk intelligently. Finally, we'll explore the power of compound interest and why long-term investing is one of the most reliable paths to financial growth. Let's begin by understanding what investing really is. Investing means putting your money into assets with the expectation that they will grow in value over time or generate income. Instead of keeping money idle or losing value due to inflation, investing allows your money to work for you. While all investing carries some risk, history shows that long-term investing has consistently rewarded patient investors. Now let's talk about the main types of investments, starting with stocks. A stock represents ownership in a company. When you buy a stock, you are buying a small piece of that business. If the company grows, earns more profits, or becomes more valuable, the price of its stock usually increases. Some companies also pay dividends, which are regular payments to shareholders from company profits. Stocks are known for their potential to deliver high returns over long periods. However, they are also volatile. Stock prices can rise and fall daily due to news, earnings reports, economic conditions, or investor emotions. This volatility can be uncomfortable, especially for beginners, but it is a normal part of investing. Next, let's look at bonds. Bonds are different from stocks because they represent loans rather than ownership. When you buy a bond, you are lending money to a government or a company. In return, they agree to pay you interest over a fixed period and return your original investment at the end of the bond's term. Bonds are generally more stable than stocks and provide predictable income. Because of this, they are often considered lower risk. However, lower risk usually means lower returns. Bonds play an important role in reducing overall portfolio volatility and providing balance, especially for investors who want stability. Now let's talk about ETFs, or exchange-traded funds. ETFs are investment funds that hold many assets in one product. An ETF might include hundreds or thousands of stocks, bonds, or other investments. When you buy an ETF, you are instantly diversified across many companies or asset types. ETFs are popular because they are easy to understand, low cost, and flexible. They trade on stock exchanges just like individual stocks, but they offer diversification similar to mutual funds. For beginners, ETFs are often one of the best ways to start investing without needing deep knowledge of individual companies. Understanding stocks, bonds, and ETFs helps you see how different investments serve different purposes. Stocks provide growth, bonds offer stability and income, and ETFs simplify diversification. Most successful portfolios use a combination of all three. Now let's move to an important topic: how to start investing with little money. One of the biggest myths about investing is that you need a lot of money to begin. This may have been true in the past, but today it's no longer the case. Many investment platforms allow you to start with very small amounts. Some even allow fractional investing, meaning you can buy a portion of a stock or ETF instead of a full share. The most important thing is not how much money you start with, but how early and consistently you invest. Starting early gives your money more time to grow. Investing small amounts regularly builds discipline and takes advantage of compounding over time. Waiting until you feel ready often results in missed opportunities. Before you start investing, it's important to build a strong financial foundation. This includes having an emergency fund and managing high-interest debt. An emergency fund protects you from having to sell investments during difficult times. High-interest debt, like credit card debt, can erase investment gains, so it's usually best to manage that first. Once your foundation is in place, investing becomes far less stressful. You can invest knowing that short-term market fluctuations won't affect your ability to pay bills or handle emergencies. Now let's talk about risk versus reward, one of the most important concepts in investing. Risk refers to the possibility that an investment may lose value or perform worse than expected. Reward refers to the potential return you earn for taking that risk. In general, investments with higher potential returns also come with higher risk. Understanding your personal risk tolerance is essential. Risk tolerance is your ability to emotionally and financially handle fluctuations in your investments. Factors like age, income stability, financial goals, and personality all influence risk tolerance. Younger investors often have higher risk tolerance because they have more time to recover from market downturns. Diversification is one of the most effective ways to manage risk. Diversification means spreading your money across different investments instead of putting it all in one place. By investing in different asset types, industries, and regions, you reduce the impact of any single investment performing poorly. ETFs make diversification easy and affordable. Instead of trying to pick winning stocks, you can invest in the overall market and benefit from long-term growth. Diversification doesn't eliminate risk, but it helps smooth out returns and reduce extreme losses. Now let's explore the concept of compound interest, often called the eighth wonder of the world. Compound interest occurs when your investment earnings generate their own earnings. In other words, you earn returns on both your original investment and the returns it produces. The key factor behind compound interest is time. The longer your money stays invested, the more powerful compounding becomes. Even small amounts invested early can grow into large sums over decades. This is why starting early is so important. Long-term investing is built around the idea of staying invested through market cycles. Markets will go through ups and downs, recessions, crashes, and recoveries. These events are normal and expected. What matters is not avoiding downturns, but staying invested long enough to benefit from recoveries. Many investors make the mistake of trying to time the market, buying when prices are low and selling when prices are high. While this sounds logical, it's extremely difficult to do consistently. Even professional investors struggle with market timing. Long-term investors focus instead on regular contributions and patience. Emotions are one of the biggest challenges in investing. Fear can cause investors to sell during market downturns, locking in losses. Greed can cause investors to buy during market highs, increasing risk. A long-term plan helps remove emotion from decision-making. Another powerful strategy for long-term investing is consistency. Investing regularly, regardless of market conditions, helps smooth out price fluctuations. This approach reduces the risk of investing all your money at the wrong time. As we move toward the end of this video, remember that investing is a lifelong journey. You don't need to know everything before you start. Begin with simple investments, focus on long-term growth, and continue learning as you go. Over time, your confidence and understanding will grow. The most successful investors are not the smartest or the luckiest. They are the most disciplined. They invest regularly, manage risk wisely, and allow time to work in their favor. Investing is not about predicting the future. It's about preparing for it. Small decisions made consistently over time can lead to powerful results. Thank you for watching this Investing Basics Guide. If this video helped you understand investing more clearly, consider liking, subscribing, and sharing it with someone who wants to start their investing journey. Remember, the best time to start investing was years ago. The second best time is today.